In a conference room at Lucent's Murray Hill, New Jersey headquarters in late 1999, sales managers reviewed a pipeline of orders. The buyers were competitive local exchange carriers, startups, companies with no meaningful revenue, burning through venture capital, building networks they could not yet afford. The orders closed anyway because Lucent agreed to lend the buyers the money to make the purchase. And the moment the equipment shipped, Lucent recorded the full purchase price as revenue before a single payment arrived, before the customer's network carried a single call. The structural question this episode answers is how a company can sell billions of dollars in equipment to customers it is financing itself, recognize that revenue immediately, and call the result growth. The mechanism at the center of the Lucent case is vendor financing. It is not, in itself, a fraud. Vendor financing is a legitimate and common commercial arrangement. To understand the distortion, you must first understand the legitimate baseline. Vendor financing occurs when a seller of goods extends credit to the buyer to facilitate the purchase. A manufacturer of capital equipment sells to a customer who cannot pay cash up front. Rather than lose the sale, the manufacturer lends the customer the purchase price or arranges financing through a captive finance subsidiary, and the customer repays over time. This is how automobiles are sold. It is how aircraft are sold. It is how a great deal of telecommunications infrastructure was sold during the build-out of the late 1990s. The arrangement transfers a financing function onto the manufacturer's balance sheet, but it is economically rational when the buyer is creditworthy and the receivable is collectible. The telecommunications equipment market in the late 1990s ran on vendor financing. The Telecommunications Act of 1996 had opened local markets to competition. A wave of new entrants, the competitive local exchange carriers, raised capital and set out to build networks. These companies needed switches, optical transport systems, and access equipment. They needed it before they had customers, before they had revenue, before they had any cash flow at all. The equipment vendors, Lucent among them, competed fiercely for these orders, and the currency of that competition was financing. The vendor that offered the most generous credit terms won the order. Lucent had been spun off from AT&T in 1996. It carried the research pedigree of Bell Labs and a substantial installed base. But as a newly independent public company, it carried something else: the expectation of growth. The market valued Lucent as a growth company, and that valuation depended on the continued expansion of reported revenue, quarter after quarter. This is the structural pressure that matters. A company valued on growth must produce growth. When the legitimate demand for a product begins to slow, the company faces a choice. It can report the slowdown and accept the consequences for its share price, or it can find a way to manufacture the appearance of continued demand. Vendor financing, deployed aggressively, is a way to manufacture demand. Here is why. If a customer cannot pay for equipment and the vendor lends the customer the money, then the vendor has not actually received any cash. It has shipped equipment and created a receivable. But under the revenue recognition rules in force at the time, if the sale met certain criteria, the vendor could recognize the full purchase price as revenue immediately at the point of shipment, regardless of whether payment had been received and regardless of how the purchase was financed. This is the hinge of the entire mechanism. Revenue recognition. The question of when a sale becomes revenue on the income statement is not a matter of when cash arrives. It is a matter of when the criteria for recognition are met. Under the governing guidance, revenue could be recognized when there was persuasive evidence of an arrangement, delivery had occurred, the price was fixed or determinable, and collectability was reasonably assured. Read that last criterion again. Collectability was reasonably assured. That is the criterion that the structure tested. Because if Lucent is lending a startup the money to buy Lucent's equipment, and that startup has no revenue and no clear path to profitability, the question of whether the receivable is collectible is not a formality. It is the entire question. And there is a further wrinkle, the one that converts an aggressive sales practice into an accounting problem. If a vendor recognizes revenue on a sale and at the same time provides the customer with rights to return the goods, or side agreements that the purchase is contingent, or credits and incentives that effectively reverse part of the economics of the sale, then the revenue was never properly recognizable in the first place. The arrangement was not what the income statement said it was. The Securities and Exchange Commission's enforcement record against Lucent and several of its former officers and employees established that this is, in substance, what occurred. The Commission's findings describe a pattern in which revenue was recognized on transactions that did not meet the criteria for recognition, through a combination of vendor financing, undisclosed side agreements, and improper credits and incentives extended to customers and distributors. We will walk through the architecture of how this worked. The first component is the financing itself. Lucent extended substantial commitments to finance customer purchases. The economic reality of these arrangements was that Lucent was funding the demand for its own products. A customer with no cash could not buy switches. Lucent provided the cash in the form of a loan or a financing commitment, and the customer used that cash to buy switches from Lucent. The cash made a circle. It left Lucent as a loan and returned to Lucent as a payment for equipment, and on the way it generated a revenue entry on Lucent's income statement. Structurally, what has happened is that Lucent has converted its own capital into reported revenue. It has not sold equipment to a customer in any economically complete sense. It has lent itself money, routed it through a customer, and recorded the round trip as a sale. The revenue is real on the income statement. The cash is not real in the bank. What sits in the bank's place is a receivable from a customer whose ability to repay is precisely the thing in doubt. Now layer in the second component. The pressure to make the quarter's numbers does not relent simply because the legitimate orders have been booked. When real demand falls short of the target, the structure requires additional sales. And additional sales, when there are no additional willing buyers at arm's length, must be induced. The SEC's findings describe how Lucent personnel offered customers and distributors a range of inducements to take product. These included credits, extended payment terms, and in certain cases, side agreements that gave the customer the right to return the product, or that made the obligation to pay contingent. Consider what a return right does to a revenue entry. If a customer takes $100 million in equipment and Lucent records $100 million in revenue, but the customer holds a side agreement permitting it to return the equipment, then the sale is not final. The revenue should not have been recognized, or should have been recognized only net of an estimated allowance for returns. The income statement reports a completed sale. The side agreement says the sale can be undone. These two documents cannot both be true descriptions of the same transaction. The third component is the role of distributors. Equipment did not only flow to end customers, it flowed to distributors who were expected to resell it. When a vendor ships product to a distributor, it can recognize revenue on that shipment, but only if the distributor has genuinely purchased the product, taking on the risk that it might not resell it. If instead the vendor is pushing product into the distribution channel that the distributor has not actually sold and offering the distributor credits, return rights, or assurances that it will not be left holding unsold inventory, then the shipment is not a sale. It is the relocation of inventory from one warehouse to another. The SEC's findings address transactions of this character, where the substance of the arrangement did not support the revenue that was recognized. Let us assemble the architecture as a sequence, because the steps are what the listener should be able to reconstruct. Step 1. Lucent identifies a customer, frequently a competitive carrier with weak finances, who wants equipment but cannot pay for it. Step 2. Lucent extends financing. The financing commitment provides the customer with the funds or the credit to make the purchase. The cash either originates from Lucent directly or from arrangements Lucent supports. Step 3. The equipment ships. At the point of shipment, Lucent recognizes the full purchase price as revenue. No cash has been received. A receivable has been created. Step 4. To the extent legitimate orders fall short of the revenue target, additional product is moved through inducements. Credits are offered. Return rights are granted. Side agreements are executed. Distributors are loaded with inventory they have not sold to end users. Step 5. The revenue from steps 3 and 4 flows into the reported financials. The company reports growth. The growth supports the valuation. The valuation creates the expectation of further growth in the next quarter. The pressure resets, larger than before. What this structure produces is a feedback loop. Each quarter's reported revenue raises the bar for the next quarter. The portion of revenue that came from financing and inducements does not convert into sustainable demand. It pulls future demand into the present, or it conjures demand that never existed at arm's length. The loop can run only as long as Lucent can keep extending more financing and offering more inducements. The moment that capacity is exhausted, or the moment the receivables begin to default, the loop reverses, and the revenue that was pulled forward becomes a hole. The Commission's findings established specific instances. In the relevant period, certain revenue was recognized that should not have been, because the arrangements included undisclosed terms that defeated recognition. Lucent ultimately restated. The Commission found that the company had improperly recognized revenue across multiple transactions, and that the conduct of certain officers and employees contributed to a misstatement of the company's financial results. The settled enforcement action, which Lucent resolved by consent without admitting or denying the findings, included a civil penalty. The record establishes that part of the penalty was attributed not only to the underlying accounting, but to the company's lack of cooperation during the investigation, a point the Commission noted explicitly in resolving the matter. Now we turn to the detection failure. The question is not whether the conduct was wrong. The Commission's findings settle that. The structural question is why it was not caught sooner by the parties whose function is verification. Begin with the auditors. The external audit is supposed to test whether revenue recognition is appropriate, but an audit relies substantially on the documentation presented to it. If a sale is supported by a purchase order, a shipping document, and an invoice, and the revenue is recognized on those documents, the transaction appears regular on its face. The problem with side agreements is precisely that they are side agreements. They sit outside the main contract file. They are the terms that defeat recognition, and they are the terms least likely to be in the documentation handed to the auditor. A return right communicated in a separate letter or in an oral understanding later memorialized informally does not appear in the revenue file. The auditor sees a clean sale. The substance is something else. This is a recurring structural weakness in the detection of revenue recognition fraud. The audit verifies the documents it is given. The fraud lives in the documents it is not given. Detection, therefore, depends on the auditor's skepticism extending beyond the presented file. On the auditor asking whether the customer could possibly pay, whether the pattern of quarter-end sales suggests channel stuffing, whether the financing arrangements are economically genuine. These are matters of professional judgment, and judgment can be defeated by a sufficiently consistent presentation. Consider what would have had to be true for the auditors to detect the problem at the point of recognition. They would have had to identify for each material transaction whether an undisclosed side agreement existed. There is no document that proves the absence of a side agreement. The auditor can ask, can obtain representations, can examine correspondence. But a side agreement that the parties intend to keep out of the file is, by design, difficult to surface through standard procedures. The verification chain has a gap at exactly the point where this fraud operates. Now consider the analysts. Sell-side analysts followed Lucent closely. The company was a bellwether of the telecommunications sector. Analysts had access to the reported financials, including the disclosures regarding vendor financing. And here the failure is more analytical than informational. The information that Lucent was extending large financing commitments to customers was, in its general shape, disclosed. The growth in receivables relative to revenue was observable. A receivable balance that grows faster than sales is a classic indicator that revenue is being recognized ahead of cash collection. This is visible on the face of the financial statements to anyone who computes the ratio. The structural reason this signal was not acted upon decisively lies in the incentives surrounding the analysis. During the telecommunications boom, the prevailing analytical framework treated vendor financing as a normal cost of competing for the build-out. Every major equipment vendor was doing it. The growth in receivables could be rationalized as the natural consequence of financing a rapidly expanding customer base. The framework that would have flagged the receivable growth as a warning was the same framework that, in the boom, interpreted it as evidence of aggressive and successful selling. The signal was present. The interpretive lens inverted its meaning. This is an important structural point. Detection failure is frequently not a failure to observe the data. It's a failure to interpret the data against the correct hypothesis. The receivables data was there. The hypothesis that it represented uncollectible revenue pulled forward was the hypothesis that the boom suppressed. As long as the share price rose, the optimistic interpretation was self-reinforcing. The market rewarded the analysts who believed the growth story and punished those who doubted it. Consider also the customers themselves as a node in the verification chain. The customers who received the financing and the inducements knew the terms of their own arrangements. They knew whether they held return rights. They knew whether the obligation to pay was contingent. But the customers had no incentive to disclose, and in many cases an incentive to conceal. The customer received equipment on favorable terms. Its interest aligned with the sellers in keeping the arrangement quiet. The counterparties to the questionable transactions were not adversarial parties who might blow a whistle. They were beneficiaries of the same arrangements. And consider the internal controls. A company's own accounting function is supposed to ensure that revenue is recognized in accordance with the standards. But the revenue recognition decision is made by people inside the company under the pressure of the growth expectation. When the pressure to recognize revenue conflicts with the standard for recognizing it, the internal control depends on the willingness of accounting personnel to resist the pressure. The SEC's findings describe conduct by individuals within the company that contributed to the misstatement. The control failed where the control always fails. At the point where the people operating it were subject to the pressure the control was meant to constrain. What would have had to be true for earlier detection? 3 conditions. First, an auditor sufficiently skeptical to test for the existence of undisclosed terms, not merely to verify presented documents. Second, an analytical community willing to read the receivables growth as a warning rather than as a feature of the boom. Third, internal accounting personnel insulated enough from revenue pressure to apply the recognition standard against the company's interest. None of these conditions held in the period in question. The detection chain had a gap at the document level, an interpretive inversion at the analytical level, and a pressure capture at the internal level. The fraud passed through all 3. We turn now to the unraveling. The mechanism we have described contains the seed of its own collapse because the feedback loop cannot run indefinitely. Pulling future demand forward exhausts future demand. Financing uncreditworthy customers produces receivables that eventually default. The loop runs until the capacity to extend more financing meets the wall of accumulated obligations that cannot be honored. The trigger in Lucent's case was the convergence of 2 forces. The first was the deterioration of the customer base. The competitive carriers Lucent had been financing were among the weakest credits in the economy. As the telecommunications boom turned to bust in 2000 and 2001, these companies began to fail. A receivable from a bankrupt carrier is not collectible. The financing that had generated revenue now generated write-offs. The cash that had circled out and back as a sale never returned as a payment. It simply did not come. The second force was the company's own difficulty in sustaining the reported numbers. A company that has pulled revenue forward must, in subsequent periods, either pull more forward or report the shortfall. There is a limit to how far forward demand can be pulled. When that limit is reached, the gap between reported growth and actual demand becomes visible in the form of missed targets. The sequence of disclosure proceeded through revisions and restatement. The company revised previously reported results. The internal review and the subsequent regulatory examination identified transactions in which revenue had been recognized improperly. The SEC opened its investigation. The enforcement record reflects that the company's revenue for the affected periods was overstated as a result of the recognition of sales that did not meet the criteria. including transactions tainted by undisclosed side agreements, improper credits, and the financing arrangements that funded the purchases. The Commission's settled action established the findings. Lucent consented to the entry of the order without admitting or denying the findings, which is the standard form of resolution in such matters. The order found violations of the anti-fraud, reporting, books and records, and internal control provisions of the federal securities laws. The company agreed to pay a civil penalty. As noted, the Commission specifically tied a portion of the penalty to the company's conduct during the investigation, identifying a failure to cooperate that aggravated the resolution. Separate proceedings address the conduct of individual officers and employees, several of whom resolved the charges against them. What collapsed structurally when the fraud was exposed? Consider what the reported revenue had actually represented. A portion of it was genuine arm's-length sales to customers who could pay. That portion was real and survived. Another portion was the round-trip financing, revenue generated by lending customers the money to buy. That portion was only as good as the receivables, and the receivables were only as good as the customers, and the customers were failing. As the carriers defaulted, the revenue that had been recognized on those sales was revealed to have been the recognition of an uncollectible obligation. A third portion was the channel-stuffed inventory and the inducement-driven sales tainted by return rights. That portion had to be reversed, because the sales were never final. When you remove the second and third portions, the growth story disappears. The company had not been growing as reported. It had been borrowing growth from the future and from its own balance sheet. The restatement was the accounting recognition of that fact, the reversal of revenue that should never have been recognized, and the writing down of receivables that would never be paid. The collapse of the share price reflected the market revaluing the company on the basis of its actual demand rather than its manufactured demand. The two numbers had diverged for years. The unravelling was simply their reconvergence. This is the general structure of revenue recognition fraud's endgame. The reported figures and the economic reality run apart for as long as the mechanism can sustain the gap. The exposure is the moment the gap closes, and it closes violently because the entire accumulated divergence is recognized at once. Now to the findings. What does the Lucent case establish about the mechanism as a matter of structure rather than morality? First, it establishes that vendor financing and revenue recognition are coupled in a way that creates a specific hazard. When a seller finances the buyer, the seller controls both sides of the transaction. The seller decides how much to lend and decides when to recognize the resulting sale as revenue. The party with the incentive to recognize revenue is the same party that determines whether the customer can pay. This concentration of both functions in one party removes the arm's-length check that ordinarily disciplines revenue. A genuine third-party sale is validated by the buyer's willingness to pay with its own resources. A vendor finance sale to an uncredit-worthy buyer is validated by nothing but the seller's own judgment, exercised under the pressure to report growth. Second, it establishes that the collectability criterion in revenue recognition is not a technicality. It is the criterion that the entire structure tests. The requirement that collectability be reasonably assured exists precisely to prevent a company from recognizing revenue on sales to customers who cannot pay. When that criterion is applied loosely, or when financing is used to paper over a customer's inability to pay, the criterion is defeated, and the resulting revenue is fictitious in substance even where it is documented in form. Third, it establishes the structural difficulty of detecting fraud that operates through undisclosed terms. The side agreement is the mechanism that defeats the documentation-based audit. As long as the terms that reverse a transaction's economics can be kept out of the file will support the revenue. This is why the regulatory response to this category of fraud has emphasized the substance of arrangements over their form, and why subsequent revenue recognition standards move toward principles that require the evaluation of an arrangement as a whole, including side agreements and contingent terms, rather than the verification of discrete documents. The accounting framework governing revenue recognition was substantially revised in the years that followed the wave of revenue recognition cases of that era. The current standard requires that revenue be recognized to depict the transfer of goods or services in an amount that reflects the consideration to which the entity expects to be entitled. And it requires the identification of all the terms of a contract, including those that would constrain recognition. The structural intent of that revision is to close the gap that arrangements like Lucent's exploited, the gap between the documented form of a sale and its economic substance. The Lucent matter, taken with the other revenue recognition cases of its period, also contributed to the regulatory emphasis on cooperation in investigations. The Commission's explicit attribution of part of the penalty to the company's conduct during the investigation reflects a structural choice: to price non-cooperation into enforcement outcomes, altering the incentive that a company faces when it decides how to respond to scrutiny. The finding then is this: vendor financing did not deceive anyone by being hidden. It was disclosed in general terms. What made it a mechanism of misstatement was the coupling of the financing function with the revenue recognition function inside a single party under pressure to grow, combined with the use of undisclosed terms to manufacture sales that the market would not have produced at arm's length. The cash made a circle, left as a loan, and returned as revenue, and the income statement recorded the circle as growth. The receivables were the record of what the cash had not actually done. When the customers failed, the receivables told the truth that the revenue had concealed. The mechanism collapsed not because it was exposed by an outside party first, but because it was structurally unable to continue. The exposure followed the collapse. The accounting only ever described, with a lag, what the economics had already determined.